Welcome to the Deep Dive. We're the place that takes these huge amounts of source material and tries to turn them into something actionable, just for you. Today, we are really tearing into a document that, honestly, it reads less like a standard corporate report and more like an economic manifesto.
Yeah.
It's the annual shareholders letter from JPMorgan Chase's chairman and CEO, Jamie Dimon. We're looking specifically at the very detailed 2017 edition.
Right. And this thing, it isn't just, ticking regulatory boxes. It's a real statement. It's about their capabilities, sure, but it's also a platform for critiquing public policy.
Exactly.
If you want to understand how a massive multi-trillion-dollar bank sees its place in the world and maybe what kind of policies it thinks it needs to succeed, well, this letter is basically the blueprint.
That's it, exactly.
Yeah.
So our mission today for you is to cut through some of the, let's say, self-congratulatory bits and pull out three key ideas. First, the actual metrics that show their discipline. Second, this really strong commitment they have to investment, specifically through organic growth, building it themselves.
Yeah. And third, how all that success, they argue, gives them the authority to propose some pretty sweeping policy changes.
And they kick it off with their strongest card, right? 2017 was a record year for earnings per share. That marked record results in, 7 of the last 8 years? That's sustained performance.
It really sets a massive foundation. We're talking net income of $24.4 billion on revenue of over $100 billion, $103.6 billion.
Wow.
They even made sure to point out, look, if you take out this one-time hit from the tax reform back then, the adjusted net income would have been even higher, a record $26.9 billion.
Okay.
Numbers like that, well, they buy you a lot of credibility when you decide you want to start, lecturing Washington a bit.
Fair point. So let's drill down into those numbers they really hang their hat on. The kind of golden metric here seems to be return on tangible common equity, or ROTCE.
Or ROTCE, yeah.
That hit 13.6% in 2017, which is strong. But the real story they tell is that long-term outperformance. They stack up their results against the S&P 500 index going way back to 2000. And they use this really critical metric, the compounded annual gain and tangible book value, TBV.
Okay, wait a sec. For maybe someone listening who isn't, deep in bank finance, what exactly is tangible book value, and why is that the golden metric for JPM?
Good question. So essentially, TBV is what the bank would be worth if you stripped out all the intangible stuff.
Yeah.
Like goodwill from buying other companies in the past.
Ah, okay, the hard assets.
Pretty much. It's seen as a cleaner measure of the core capital value that the shareholders actually own. And over that period, JPM's TBV grew by 11.8% every year, compounded.
11.8%.
Yeah, and that just crushed the S&P 500's 5.2% gain over the same time.
Okay, so that's the CEO's big proof point, right? That being huge and stable doesn't have to mean you stop growing.
Exactly.
And what about the stock itself, the total return?
Yeah. If you look at the total stock return, assuming you reinvested the dividends, JPM delivered a 691.5% overall gain since 2000.
690%.
Yep, compared to just 147.3% for the S&P 500.
Yeah.
So that kind of like hyper growth for a giant like JPM, and it really shows that their approach to deploying capital, it works.
Makes sense.
And they use that track record, that performance, to talk about their capital allocation strategy, which interestingly includes these massive stock buybacks. They bought back nearly $40 billion worth over the previous 5 years.
$40 billion?
Yeah. Now, they say they prefer to use capital for organic growth first.
Right.
But they definitely support buybacks. Even, they say, at valuations well above tangible book value, like 2 times tangible book.
Doesn't that sort of risk overpaying, though? Or is that just, corporate talk to manage expectations, buying back your own stock when it's already priced high?
Well, the way the letter justifies it is by looking ahead. They project they can achieve a 17% ROTCE for the foreseeable future.
17% return? That's ambitious.
It is. But if they can consistently hit that high return on equity, then mathematically, even buying back stock at, say, 2 times tangible book value, it actually ends up benefiting the shareholders who stick around. It's a very aggressive statement of confidence in their future profits.
Okay. That makes sense. And that confidence, I guess, feeds right into their strategy, this organic growth engine idea.
Exactly.
This commitment to growing internally, hiring people, training them, opening new branches, and maybe most importantly, innovating new products and tech, rather than just, buying other big companies.
Yeah. And Dimon notes in the letter that organic growth is actually hard. It faces internal pushback sometimes. because it means taking on new expenses up front, maybe even creating some internal competition between divisions. But he insists that discipline is crucial for the bank's long-term health.
And their plans back then were pretty concrete. For the Consumer and Community Banking Division, CCB, they announced this 5-year plan to push into 15 to 20 completely new markets, specifically calling out places like Boston, Philadelphia, D.C. And they weren't just, like, putting up a few ATMs.
Right.
No, they were bringing the whole package. Mortgages, investments, small business banking, even their corporate responsibility stuff. Planting the flag properly.
But the real fuel for that engine, it seems, is technology. Well, wait a minute. The letter says 50,000 employees in technology.
Yeah.
50,000. Yeah. It's the size of a decent tech company just operating inside a bank. What does that even tell us about what their main product is becoming?
Well, it tells you the product isn't just money anymore, right? It's secure, convenient financial services. And of those 50,000 people, over 31,000 were focused purely on development and engineering roles.
Wow.
They were pouring money into AI, big data, machine learning, all aimed at cutting risk, stopping fraud, making service better, improving underwriting.
The works. The specific digital products they mentioned are kind of fascinating, like little snapshots of that time. They were piloting Fin, which was supposed to be a fully mobile bank.
Right, I remember Fin.
Integrating facial recognition into the main Chase app and really pushing things like Chase Pay and Zelle. Zelle for real-time payments between people. Trying to win that digital payments battle against all the fintech startups.
Yeah, that was heating up. And they also used the letter to sort of stake a claim on data privacy as a competitive edge.
How so?
They highlighted this new deal they'd struck with Intuit. The idea was that customer data would be pushed through an API, like a secure channel,
Okay.
instead of customers having to hand over their actual bank passcodes to third-party apps like Mint. They were aiming to set a new industry standard there, basically competing by being the safest place for your data, which also helps reduce their own liability, of course.
Makes sense. Be the most trustworthy. Like I said, they're spending billions on tech, expanding their footprint. But building an engine that big, well, it must create enormous systemic risks, right? How do they talk about managing all that complexity?
That brings us right to the fortress balance sheet.
Ah, yes, the fortress.
Exactly. That whole concept is about maintaining just extraordinary financial strength, way, way more than regulators require, so they can support their clients through thick and thin, which is obviously a nod back to the 2008 crisis.
Right.
Their core capital measure, the Common Equity Tier 1 ratio, it basically doubled from 7.0% back in 2008 up to 12.7% by 2017. Just a huge buffer.
And their approach to managing risk itself is, well, it's pretty eye-opening. They apparently run several hundred tests a week internally.
Several hundred.
Yeah, these complex, potentially disastrous scenarios, which is a stark contrast to the big annual regulatory stress test, the CCR test.
Right, the one the Fed runs.
Yeah. And the letter states that even if the Fed's test predicted, say, an $18 billion loss for JPM and a really bad downturn, JPM's own internal analysis suggested they'd probably still be profitable almost every quarter, even in that scenario.
That's hypervigilance. It's focused on managing those really extreme events, the fat tails, the things that almost never happen but can break the system when they do. And they really emphasize relying on human judgment over just the mathematical models, because models, they often miss the unquantifiable stuff like political risks or future changes in law or even just like bad character and leadership somewhere.
That's a really important point.
Yeah.
So if they feel so incredibly well capitalized, what were the biggest systemic risks they actually saw brewing back in 2017? What were they worried about?
Well, the number one worry cited in the letter is the reversal of quantitative easing, QE.
Ah, the great unwind.
Exactly. Since central banks had never done QE on that massive scale before, nobody really knew what unwinding it would actually do. They warned that interest rates could jump faster and higher than people expect, especially if inflation and wages suddenly picked up steam, catching the market completely off guard.
Okay. They also give this really critical breakdown comparing the environment back in the 2009 crisis to the present day, or 2017. The positives were clear, right?
Yeah, definitely. Far more capital in the system, way more liquidity sloshing around. Consumers were generally healthier financially, and mortgage lending since '09 had been super cautious, pristine even.
Okay, so stronger foundations in some ways. But what about the negatives? What new fragilities did they see?
They flagged two big shifts in the market's plumbing, basically. First, way more money was being managed passively in ETFs, index funds, things that people assume are super easy to sell instantly.
Right. Liquid.
Supposedly liquid. But if everyone rushes for the exit at once, trying to sell their ETF shares, but the actual underlying stuff like corporate bonds or loans isn't trading easily, well, that's a huge liquidity mismatch. That's a risk that just wasn't there in the same way before 2009.
Got it. The exit door looks big, but the hallway behind it is narrow.
Good analogy. And second, the capacity of the market makers, the big banks that are supposed to absorb shocks, was dramatically smaller.
Really? How much smaller?
The letter says primary dealers held average positions of about $530 billion back in 2007. By 2017, that was down to just $179 billion on average.
Wow, that's a huge drop.
Huge. It means even a relatively small market panic could potentially escalate much faster today because the banks just don't have the same capacity or maybe the regulatory willingness to step in and absorb the selling pressure.
Okay, that makes sense. Less shock absorption. Any other big worries?
Yeah, finally, they frame cybersecurity basically as an arms race, stressing that U.S. cyber laws back then were just inadequate, especially regarding how banks and government agencies could share threat information in real time. They argued for much closer collaboration just to keep pace with the attackers.
Right, an ongoing battle. Okay, so that takes us from the balance sheet discipline to this broader idea of responsibility that's woven through the letter. The argument seems to be pretty simple. You can't maximize shareholder value in a vacuum. You have to serve customers, take care of employees, and help lift up communities.
And the investment seems to back that up. They announced this huge increase in their philanthropic spending, $1.75 billion over 5 years.
Billion with a B.
Yep. And that famous Detroit model they developed for helping revitalize neighborhoods. They explicitly said they were extending that approach to Chicago, D.C., and the Bronx, building on what they learned.
And the specific programs mentioned are designed for measurable results, right? Things like the Entrepreneurs of Color Fund, helping minority business owners get capital, and the Fellowship Initiative, TFI, which supports young men of color. And they boast it had achieved a 100% high school graduation rate for its participants. The underlying message is almost fix the community and the business results will follow.
Diversity inside the company got attention too.
Yeah.
They noted 50% of their global workforce were women. And crucially, 50% of the senior leaders on the operating committee, the ones reporting directly to Diamond, were women.
That's significant at that level.
Very. They also highlighted a specific strategy called Advancing Black Leaders, or ABL, and they pointed to an immediate noticeable increase in the number of Black managing directors just in 2017, up from 83 to 97.
Okay. And then, following the big U.S. tax reform in 2017, they jumped in with this $20 billion 5-year investment plan.
Right.
And that included tangible things like raising hourly wages for, I think, 22,000 employees, and significantly cutting medical plan deductibles for lower-paid workers, those making under $60,000.
Yeah, directly tying those investments back to the new economic landscape created by that policy change.
Which brings us full circle, really, back to the CEO's perceived authority. Because having laid out the case for their financial discipline, their strategic investment, their community responsibility, the letter then pivots pretty hard into this detailed critique of the federal government. The core argument is that U.S. economic growth had been, frankly, anemic, about 20% growth over 8 years, when a normal recovery should have seen maybe 40% or more.
And they blame bad policy.
Primarily bad policy, yeah. Things like an uncompetitive tax code, pre-reform, excessive regulation, lack of infrastructure investment.
Okay, it's, a compelling agenda they lay out. But we do have to remember, JPM is a business. How much of this policy push, like arguing for a competitive tax system or fixing infrastructure, how much is genuine altruism versus, well, things that would also lower their own operating costs or help them get the STEM talent they need?
That's the million-dollar question, isn't it? Or maybe the trillion-dollar question. The source presents it all as necessary for the health of the entire economy, which, naturally, would benefit the bank too.
Makes sense.
Their specific prescriptions are quite detailed, though. For social safety nets, they argue for reforming and expanding the Earned Income Tax Credit, the EITC.
How so?
The idea was to convert it into a negative income payroll tax. The thinking was that would maximize distribution, get money out faster, minimize fraud, and also make it more available to workers without children, who often got left out.
Interesting tweak. What else?
Infrastructure is a huge theme. The letter quotes an estimate that fixing America's aging infrastructure would cost something like $4 trillion.
$4 trillion. Wow.
Yeah, But then it argues the cost of not fixing it is actually even higher, over $200 billion every year, just lost to inefficiency, delays, crumbling roads and bridges, you name it. Makes the $4 trillion investment look almost cheap by comparison.
Perspective. Okay. And healthcare. That was the time they announced that big splashy venture, right?
Yep, the joint venture with Amazon and Berkshire Hathaway. The stated goal was to tackle high healthcare costs by trying to align incentives better, cut down administrative waste, improve wellness programs, starting small with their own employees, but hoping eventually to figure out things that could inform public policy more broadly.
Ambitious. And from a corporate governance angle, what were they pushing for?
This one's interesting. They argue really strongly against companies giving quarterly earnings guidance.
Oh, yeah.
The belief expressed is that it forces companies to become way too focused on the short term, just hitting the next quarter's number. And that makes them hesitant to make the big long-term investments in R&D, in technology, the very things JPM argues are essential because those investments might hurt profits for a quarter or two.
Right. Sacrificing the future for the present ties right back to their focus on long-term organic growth.
Exactly. And finally, immigration, a really hot topic. Then and now. The push in the letter is for comprehensive reform, addressing three key things together.
Which are?
1, better border control. 2, finding a path to legal status for the dreamers, the undocumented immigrants brought here as children. And 3, moving more towards a merit-based immigration system, specifically citing the need to give green cards automatically to foreign students who get advanced degrees in STEM fields from U.S. universities. Keep that talent here.
Got it. Keep the scientists and engineers. Okay, so let's try and pull this all together into the final synthesized story for you, the listener.
Yeah. This letter, when you read it closely, it's really a masterclass in corporate positioning. First, they lay out the case for their financial discipline, using those hyper-performance metrics like TBV growth and ROTCE, proof of performance.
Right. Then second, they showcase their deep commitment to internal investment through that organic growth engine, highlighting how they're effectively becoming this giant tech company that also happens to be a regulated bank.
Building the future internally. And third, all the demonstrated success, they argue, provides the authority, the standing for the CEO to step onto the public stage and make the case that business has to partner with government to fix these really fundamental economic challenges, from EITC reform to infrastructure, healthcare, you name it.
Yeah. But here's where it gets, I think, really interesting. And this is the thing we want you to really mull over after listening. The CEO explicitly voices this fear about the decline of public companies in the U.S. He cites the stat that the number of publicly listed companies fell by about half, 50%, between 1996 and 2016.
Half the companies gone from the public markets. Wow.
Yeah. And this raises a really important question for you, the listener, and maybe for, Mr. and Miss 401k out there.
Right.
What is the long-term cost? When all that wealth creation, that job growth, that innovation that used to happen inside publicly traded companies, what happens when more and more of that occurs behind the closed doors of private companies, private equity, venture capital, essentially limiting access for the average retail investor?
That is a powerful thought to chew on, especially as you think about where the next decade of American wealth creation might actually be taking place and who gets to participate.
Definitely something to consider.
Thanks for joining us for the deep dive.